How's it going, everybody? It's Stas here. So it's no secret at this point that the stock market is at all-time highs. It's been doing very well over the past 10, 15, 20 years. And a lot of people are saying, hey, this thing needs to come down a bit. It needs to cool off. It needs to see a crash, a big correction. And I personally agree with that. And I do think at some point, no one knows when, but at some point, we are going to see this big crash. And in this video, I want to cover some stocks, all of which are bigger tech stocks that I'm looking to buy when we do see this crash. And full disclosure, some of these I already own, but when we do see this crash, I want to buy a lot more of these stocks. And I want to talk a little bit about inflation in this video, the Shiller P as well. So sit back, relax, take a sip of your coffee, check out my Patreon down below for all my real-time moves if you guys want, and let's get right into the video. So you guys can see QQQ, which tracks the NASDAQ 100, over the past 20-ish years, this has gone from $20 to over $330, and I can't even do the math in my head to give you all what return that is, but let's just say it's over 10, 15x, right around there, which is unbelievable. SPY has gone from about $67 in 2009 all the way over $400 now, and this tracks the S&P 500, which I'm sure all of you know at this point. The Russell 2000 has gone from 324 points, now over 2,300 points, and the Dow Jones Industrial Average has gone from 6,500 in 2009 all the way to over $34,000. And a lot of people, and I tend to agree with this, and it's pretty obvious at this point, you can't argue it. A lot of people are saying, hey, the reason why this is happening is because of the Federal Reserve. You know, all the money printing, the 0% interest rates, it's causing an asset bubble, whether it's in, the stock market, real estate, other assets. We're seeing this in pretty much every asset class, which is why you're seeing the divide between, and it's called the K-shaped recovery, whatever you want to call it, the divide between the average Joe out there and the 1%, or the people that own these assets. Because when there is money printing, when there is 0% interest rates, the rich get richer because, like I said, and it's pretty obvious based on these charts, stocks go up, real estate goes up, but we're also seeing inflation, which is eroding away the purchasing power, and it's obviously making and ultimately making the average Joe out there poorer because the dollar isn't going as far as it once did. So if you don't own assets, the moral of the story is, you're losing your purchasing power over time, at least the past couple, 10, 20 years, the way that the Federal Reserve has been running things. And we're obviously seeing the Shiller PE, which I've mentioned before on my YouTube channel, which is also known as the CAPE ratio. And let me give you all a quick rundown on what this is. The CAPE ratio is a valuation measure that uses real EPS over a 10-year period to smooth out fluctuations in corporate profits, and it pretty much just shows a 10-year glimpse of the PE of the overall stock market. And as of now, the Shiller PE is at a 20-year high. It's at 37. And the last time it was this high was back in the dot-com bubble, where it was over 40 in the dot-com bubble. So we're having PE ratios at all-time highs. The Shiller PE is at all-time highs. And like I said, the Federal Reserve is pretty much blowing this thing up, right? And now we have inflation. Inflation is the X factor here, ladies and gentlemen. Inflation, if we see higher inflation, and I've mentioned this before on the YouTube channel as well, and by the way, we do get that May CPI number. We get the May CPI numbers tomorrow at 8:30 a.m. on the East Coast, right? If we get higher inflation, this is going to hurt the stock market, especially the higher growth, the big tech names. These names are going to get hurt. And higher inflation means that the Fed needs, and maybe, and they might not do this, probably won't do this, but, the Fed, they need to raise interest rates in order to fight inflation. And what this does, higher rates pretty much brings down the future valuation of these businesses that are projecting high growth into the future. Because you have a higher rate of inflation, the discount rate is higher. That is bringing down the future valuation of these stocks. Hence why the high growth names, if we do get higher inflation and the CPI number reads that we do have higher inflation, these high growth names, they are going to see a drop. So this is very risky right now, guys, and investing in these day and ages, in today's day and age, unless you're finding a very good deal, or unless you're just simply averaging in over time, which I definitely recommend doing, although I'm not a financial advisor. But let's say you're starting in these days, where the markets are at all-time high, Schiller PE, inflation, all this stuff's going on, all this craziness. This is a very, very risky time to start. I'm not trying to discourage you guys from starting in the markets, but I'm just making you aware of what is going on and the current levels that we're at. Like I said, the Schiller PE is at 37. It was at 40 in the dot-com bubble, and you guys remember what ended up happening after that, right? So let's talk about some of these stocks which you could argue are overvalued because of the Federal Reserve, money printing, everything that's going on right now. You could argue they're overvalued, and I'm going to tell you this. I own these stocks, some of them, and I want to buy more of them during the next crash. So number one is Amazon, AMZN. This one currently has a $1.66 trillion market cap. The PE ratio in the trailing 12 months is 62, which is pretty high, I'm not going to lie. And the forward PE, which is lower, which tracks the forward 12 months here, this is a good sign, is 54, which I'm liking. And as you all can see on the 20-year chart, Amazon is it's doing super well. Let's put it that way. It's gone from $5 in 2002 all the way to $3,500, which is ridiculous, that return. And I would like to see Amazon, and the next time the market does crash, which it will, guys, trust me, I would like to see Amazon in the lower 2000s, maybe into the 1800 level. I feel like that would be an excellent time to start adding more into this. Let's say when that PE gets to 20, 30, that would be a pretty attractive spot. And that's where the PE would get to if this stock were to half or, go down 30, 40%. So Amazon's number one, and this is one that I own. I believe my average cost right now on Amazon is about $2,600, maybe $2,500 per share. Now we're sitting at $3,300. So I'd be more than happy to add more if it were to get down to, like I said, $1,800, $1,900, $2,000. That is very attractive. Shopify is one that I don't own, which I want to own in the future during this next drop. And the thing is, guys, when you're in the markets, I know it's very exciting to buy stocks. You want to throw all your money in at once. But the key to being a good investor is analyzing the fundamentals, understanding the financials, all that good stuff, the ratios, and knowing where you want to buy, having a buy target, and being patient and waiting for that buy target. So Shopify is one, like I said, that I don't own right now, but I do want to own it. It's a $152 billion market cap. The PE ratio is 95 for trailing 12 months, and the forward PE is 333, which is just unbelievable. So for Shopify, I'd like to see this thing under 1,000 for me to even consider it. Maybe even under 800. Honestly, under 800 would be ideal. And, that is probably where I'm going to set my alert for this stock. And again, this might not happen for a year, 2 years. It might not go under 800 for the next couple years for all we know. But I'm going to be patient and I'm going to set my alert there. And like I said, it's all about having price targets. Number three, which is my favorite tech stock and my number one long-term holding, is Google, right? Ticker symbol, wait, what is this? This is not Google. This pulled up the wrong ticker. Hold up, guys. It's ticker symbol GOOG, also known as Alphabet. And this is one that I own. My average cost is, I think, $1,800, $1,900 on Google right now. And the market cap on this bad boy is $1.6 trillion. And the PE on this, believe it or not, although it's very high in terms of price, it's not that bad considering my personal belief of YouTube being undervalued. And I think the growth for YouTube is going to stun investors and traders over the next couple of years. I truly believe that. The PE right now on Google is 33, and that is for the trailing 12 months, and the forward P is 30. So even though we're up a ton, the stock's at all-time highs, the PE is not too bad. And I don't want to say it's undervalued here because, come on, guys. It's at all-time highs. It's ran up a lot, so it's not undervalued per se. But it's you can make an argument that it's more fairly valued than an Amazon or an Apple or a Microsoft. And I can tell you this. If Google were to go down anywhere near this 50 moving average on this 20-year chart, if it were to drop anywhere under 2015, if it got down to 1500, guys, I would be loading the boat on Google left and right. I'd be buying leaps. I'd be buying call options at many different strikes, and I would just go all in if it were to go under that. And if it were to get under, let's say, a 20p or something like that, Google would be extremely, extremely attractive. So, yeah, Google is number 4 here. And the last stock that I'm looking at, next crash, is none other than Apple, which I could say Apple is in the same camp as Google. Maybe it's not that bad when it comes to PE, but I'd argue that Google has more growth than Apple. So, Apple's PE needs to come down a bit because Apple is currently a $2 trillion market cap, 28.5 PE for the trailing 12 months, which is a little bit lower than Google. And the forward PE is 23.6 for Apple here. So if Apple's PE were to get down to 20, maybe under 20, 17, 18, right around there, I think that would be a pretty strong buy. And this is one that I do own for the long term. I own all of these stocks other than Shopify, right? So, yeah, guys, look, Apple, the next time this market takes a hit, it's probably going to go under 100. And if it goes anywhere from $75, $80, $90, $100 per share, I will be buying a ton of Apple anywhere from the 15 to 20 PE range. So that's it for this video, guys. I don't want to hold you all too long. These are some stocks that I'm looking at for the next stock market crash. And be patient. If I want to leave you all with any message today, it's be patient. Inflation is here. We're going to get this data over the next couple of months, every month, and this could affect the markets heavily like these high growth stocks. And be mindful of the PE, of the overall market and the Shiller PE. This stuff is real and it should not be ignored, guys. So overall, if you all enjoyed the video, hit that like button, subscribe, drop a comment down below. Let me know your thoughts, and feel free to check out my Patreon if you guys want my real-time buys, sells, if you want my call-outs throughout the day, and if you want an exclusive morning update video every morning and more access to me throughout the day. All of that's on Patreon, link down below. Or you guys can go to StockSurfest.com/Patreon. That is StockSurfest.com/Patreon. Don't forget to also get your free money from Webull, from Coinbase, from M1 Finance. All of those are linked down below. I'll catch you all in the next video. Thanks for tuning in. Again, as always, keep crushing the market. Stay safe out there, guys. Peace out.